All right, good afternoon, everybody. Event trader Gavin McGuire here, and I'm about to be joined by Brett Manning. Brett, you with us?
Yep. How you doing?
Doing good, doing good. A little crazy start to the day, right?
Interesting stuff.
Yeah, yeah, definitely is. So, be curious to see how some things play out here. But I suppose that's what we'll try to get into and figure out. But I suppose you haven't had a chance to really kind of voice your opinion too much. Obviously, you played a little bit of a role in the YMs there, and
I
then
almost got out long the market a few minutes ago as well, but I wanted it to consolidate a little bit further. But I think we're headed to either retest the highs of this morning and move above that on this leg, but I'd like to see it roll over first and consolidate and then do that tomorrow.
so I didn't see that last trade. When did you get
I
long
didn't
here?
I didn't put it on. I held off.
Oh,
I'm
okay, you
just
held
telling
off
people
on
that,
it.
that I've been sitting here debating whether or not to buy the market and ultimately decided not to in a sort of just capitulating to the sense of midday, mid-August. I could see us kind of having a couple head fakes and consolidating this sideways after this morning's impulsive breakout to the upside. I would think that we are going to top this morning's highs. I would like to see it stall out around here, reset back under 29.25 in the S&P, and then move back up and maybe test 29.50 tomorrow.
Okay, so let me ask you this. What kind of pattern would you be looking at? Because I know for myself, if it rolled back under 29.25, I would also be a little cautious there. That'd be a tough place to add for me, just in terms of how I generally look at things. So what would be the pattern you'd want to see fold out in that scenario?
Well, I mean, I just think that that's exactly to stoke that caution again, and to get orders reset so that you have shorts back in the tape, so that you start to get people betting against it. You start to get some momentum players on the long side shaken back out again. So you kind of reset the market so it can reverse and move back through those same orders on the other side, and that kind of allows us to move through and break out and extend the rally. I mean, I just think, some of the data that we're going to be talking about on this show suggests that we got to a relatively dramatic extreme of bearishness in some of the data points that we're looking at. And when you start to see at least a gesture in the direction that we went in with the headlines, I know that it's not a large shift in terms of the value of things, and we could talk about that as well. But you're starting to see a little bit of a gesture. What you and I agreed over text earlier is sort of like a White House put coming in, at least psychologically, into the market. I mean, you're in a situation where I think that you're probably going to see a move above this morning's highs, not necessarily back to previous highs, but I think that there's more upside reaction to take advantage of.
How do you view the Hong Kong news and its potential impact on the markets?
Um, I think that it probably is something that can keep. I think that probably it's something that can build up bearishness, although not in a manner that will materially impact things, and in fact probably stoke short squeeze potential in the market.
Yeah, I completely agree with that because I basically, when I came in, I was talking a little bit with Jim about it, and my point was if this happened 2 weeks ago, you probably wouldn't even know it was happening.
Yeah,
Meaning
sure. I mean,
there's no other news out there for people. So there, and not to not to minimize what's going on over there by any stretch, but in terms of the financial impact. But I guess there's got to be some aspect of it being one of the Asian financial capitals that there's got to be a
there's that.
little bit of an outsized impact, right?
There's that, and I suppose you could look at. I mean, there's a tiny, tiny bit of this that is wrapped up in a very different version of the sort of Arab Spring kind of idea about China generally speaking. And it's nothing that becomes activated fully, but there's a little bit under the surface of, I mean, Hong Kong and Macau and a couple areas are kind of, they're sort of like gardens of capitalism that are still under the purview of China generally speaking. And there's freedoms there that don't exist in the rest of the country, and if those freedoms gradually are encroached upon by the overarching Chinese machine, and there's a pushback in the face of that, and the pushback gains international support, and it becomes a sort of digging the heels in of the people that are a part of that regime, then I suppose there's some tiny fraction of a percent probability that could start to spread to the mainland in some way and discredit the Communist Party in China, which would have massive implications for everything. And I'm not saying that's going to happen at all, but there's at least it's something that points in that direction, even if distantly and in a very small percentage way.
All right. Let me ask you this. So I saw a stat that ended yesterday, but we had a run of 8 straight sessions going at least a 1% intraday change in the S&P 500.
Yeah, isn't that beautiful?
That is, and I mean, for somebody like yourself who loves volatility, that's something that you're just waiting around for to make your quarter. Let me ask you this. Obviously, we cooled off a little bit. I haven't seen the percentages yet, but I guess we got to be up close to 1% for today, I would think. How do you view this sort of volatility?
Wait. Percentage move in what?
In the S&P 500.
We're almost 2%.
We're at 2% now. Like I said, I hadn't checked, but I assumed that we were.
Yeah, well, I mean, it's another big wide range. Yeah.
Right. So let me ask you this. What do you take of that in terms of for maybe not the longer term picture, but in how you are looking at the market set up for the end of August into September and then October? You know, obviously we start moving into Q3 earnings, and we'll have a little bit more behind us with the Fed meeting on September 17th and such. But how do you view a volatile run like this? And I guess the 8 straight sessions, I didn't take a look at the exact dates, but that's got to go back to the Fed day, right? I would think.
Probably. Yeah, I'm going to think about. Yeah,
because then we had the Fed, then we had the Trump tweet the day after.
Absolutely. There's a mode change in the market, and it is distinctly beginning with the Fed. And not that the Fed set it off. The Fed did something. It started to happen, and then other things happened too.
Right. If we don't get the Trump tweet on tariffs the day after, we're probably not talking about this stat right here.
Yeah. No. I mean, and I think sure. Yeah.
But how does this sort of volatility factor into your trading up until the next few weeks? I guess until mid-September, because we really are kind of we're towards the back end of August. I'm sure we got Jackson Hole in next week, but for the most part, there's really not a lot on the calendar that could be earth moving. Obviously, there's always your black swan events, such as a Hong Kong potential type thing or whatever. But how does this impact your trading moving forward, and how do you view the markets right here for the next few weeks?
Well, I'll tell you the main impact. The main impact to me is, in terms of personal scheduling, I was hoping to have a vacation. Yeah. And, this is one of the drawbacks to my style of approach to markets is, when it rains, it pours, and you have to take advantage of that. And that's, and so we're starting to get, if we are moving into a sustained period of VIX above 17 or 18 for, several weeks, and that's a period when I need to be doing a lot of trading to have the system that I use work out, and so that just means canceled vacations in certain instances, and this will be one of them if we have that, an August period of, if you have August 1st through Labor Day and just after as a sustained period of volatility, it's kind of frustrating, quite frankly. But but it's great at the same time because this is a shooting fish in a barrel kind of market for me right now, and taking advantage of it. I know that I get this period now, and so whatever happens rest of the year, I've already been able to salt away something that means the performance is there. So it's good in that regard. As far as what does it signify about the future, I tend to think pretty non-deterministically about volatility. I think that we're in this mode right now. Wide and loose price action signifies a lack of complacency, generally speaking. And so there is the possibility of, if we get a sort of positive fundamental resolution to things, then we've seen, and you and I have talked weeks and weeks and weeks and weeks and weeks about how much money has moved out of equities and into bonds, generally speaking, over the course of 2019. It's been the main theme. And if there's anything that brings us out of this volatility in a direction that people start to shift that allocation trend, then this market has tremendous upside potential. But at the same time, I am kind of taken with the sense that that we seem to be seeing a deterioration that kind of goes beyond that a little bit in certain ways. And I'm also struck by the implications of the way that the PBOC and the Fed together are seemingly engaging in a sort of game theory trap as far as enabling an infinite escalation of the trade war. And that's something that at the same time enables a kind of infinite degradation of business investment and spending. And those factors kind of all conspire to suggest that we may be in the process of seeing something that has more legs on the downside, particularly if we do what I often talk about as being kind of the most bearish thing you can see is a shift to extreme bearish sentiment, a shift to very high volatility, and then a consolidation period where you don't get back anywhere near the previous highs, but you see the sentiment data cycle back through the other way.
Now that would signal to you what, that there's just
that you want to short the crap out of the market. What's that?
On the idea that there's just no buyers out there at those levels.
I don't know to do the tape composition analysis underneath it. All I know is it's a signal. If you see that kind of thing, if you see, flashy rallies like this, headline-driven spikes to the upside, but you're still well off the previous highs, you're still not technically healed, and then maybe you see a couple of tighter range days, but sentiment data ticks back up. You just see people starting to become more optimistic, but the market isn't recovering. So when you see that sort of lower high on a jump, a strong jump back up, and we're miles away from that. So this would be what happens over the next 2 weeks.
You're saying for the signal to hit, we obviously got to start climbing through the 50-day moving average and working our way back to that 3,000 level.
The market isn't the important thing. The market may sit right here, but if time passes and people acclimate to whatever's going on and start to register more bullish sentiment in the midst of the market not going up, that's the problem. So if we sit here, let's say we sit just exactly at this price in oscillations of 0.5% one side or the other for the next 2 weeks, but you and I are talking in 2 weeks on a sentiment and flow show and sitting here saying, boy, we went from bearish extreme all the way back up to bullish extreme. That's the signal for you to just really start shorting the crap out of everything. Right. That is a very bearish signal that could happen here. And if it does, I think that it would set up possibly a something that looks like a really larger time frame kind of potent bearish technical pattern. If you look at things like weekly charts, you kind of have a failed breakout to new highs. That's what it amounts to. What we saw in June and July. If we move back over and roll back under the 200-day averages after something like that. So if you get 2-3 weeks sideways movement, sentiment really rips back the other direction, all the way to the other end of the spectrum, and then we start to tick down, and we get a feeling of like what I call a lead blanket offer on the market, right. And then we start to accelerate down through, and we don't see a bearish extreme immediately reemerge. We see people, theoretically thinking in terms of a buy the dip mentality. We've got some real values accumulating in the market, and we break back down under, let's say, 2750 in the S&P, and we head under the 200-day moving average. Then you've got what amounts to a failed breakout in July over to new all-time highs, and then a rollover, and it starts to look like a very bearish pattern. And if at the same time we've got all these big inversions in the yield curve, and we've got policymakers in the U.S. and China really enabling a kind of permanent instantiation of the trade war that just keeps escalating, and businesses respond to that by realizing they've got a large process of logistical reengineering, then that all makes for a kind of serious bear market threat. And I think that would be how that works out. So there's one sort of scenario building exercise, and that would be signaled by the market unable to make dramatic progress from here. We got the flash on the headlines. If we now can't really make dramatic progress higher, but we start to see sentiment data indicators really recycle back through.
And,
So this
and
probably
hit the bullish sentiment.
start to show like everybody's really bullish, and the market's way off the highs. You see like a divergence there. More bullish than we were even at the previous highs.
And we can't get over the 50-day. That's
some problems.
And we can't, for argument's sake, get over the 50. That's raising a red flag for you.
Huge red flag. That's the principal red flag that there is for me. And so that would really set up. And we saw the exact same thing back in November, by the way. And then we really crashed in December.
Yeah.
That was off of that same type of signal. We had the volatility in October. We had some of the, the risk parity problems that we talked about then. And then we had the market really recycle. We got the promised trade deal at the G20, I think, then. Or either Argentina won. Wasn't that Rio?
That was Argentina G20 meeting.
Yeah, we got the big promised trade deal, and there was a big flash to the upside, and sentiment data all reorganized itself positively, and then we rolled over, and that was really what opened up that trapdoor move. And I think that if we did it again now after a weekly chart field breakout to the upside, it becomes much more concerning on a longer term basis. And so, that's one scenario to watch out for. I'm not saying that's what's going to happen. I just think in these terms. I'm just saying if I see this, then this. If I see that, then that. But right now, we should switch now and talk about the sentiment data we do see, because it's really at the other end of the spectrum again.
Yeah, and I was just going to move into that. So I just wanted to get some game theories out there for the longer term. But now let's, as you said, circle back and take a look at some of this data that we're seeing. Now, for the most part, I was seeing on my side here, Brett, a lot of the middling data. I know we've been focusing a lot on the options data, so I figured we would start from there. And just looking at three of the studies that you usually follow, the option speculation index, the LOBO ratio, and the ROBO ratio. What I was seeing from there was seemed to me like a lot of uncertainty. Just from
the options ones are the wild card. So I don't know if you saw my notes this morning. They're the sore thumb sticking out. Like there's a lot of other data points that say people just got really bearish. And then you look at the options data, and it's just not there. It's
just not there, exactly.
It's really strange.
So, now I did see some comments around, like, for instance, just taking a look at the LOBO ratio. What I was seeing was people talking about the smallest traders didn't adjust their behavior very much. They were only reducing their speculative call buying and raising some put purchases. So that would be a little bit more on the bearish side, obviously.
But we're back in the middle of the range looking at ROBO. Right in the middle.
But the LOBO guys, they were reducing their call buying by a lot, is what I was seeing. So
yeah, right. I mean, we're okay. I mean,
which again would be bullish or bearish, right? So
yeah, right. I mean, you're so the LOBO is showing a little bit more of what would be in line with, I mean, if you look at, I don't know if you took a look at the American Association of Individual Investors data last week, but it was one of the biggest shifts toward bearish that we've ever seen in that index. And we've got things like, one of the things that we looked at, all the market-based stuff is, on the floor, like everything based on the bond market movement. And then the SPY liquidity premium continues to be really kind of stacked in that direction. VIX term structure really stacked in that direction. We've actually got the equity hedging index a little bit in that direction, a little bit more, but the bull ratio was dramatic if you look at the AAII data. But otherwise, you have a lot of different ways of looking at the options market behavior. I kind of outlined them in my morning notes this morning. I kind of look at the option speculation index that you really brought to my attention a few weeks ago. And then a standard for me is the 10-day moving average on the closing number for the CBOE total put call, and then the LOBO and the ROBO. And if you take them all together, there's really no sense that there's a uniform feeling of people really scrambling out of calls and into puts, the way that you would typically see when you see other things that we see right now. For instance, some of the stuff in the B of A fund manager survey and the surveys in general.
Well, I was just going to say for Lobo, I didn't say that they were scrambling out, but they just didn't seem to be buying calls either.
Well, right, no, sure, and there's obviously, I mean, that ratio is not too far off of an extreme, so it's there. It's moved up quite a bit, yeah.
Yeah, so, and particularly on the sentiment data that you're talking about, but allocation to that continues to show a rotation out of equities. We saw, what was it, I believe it was the rotation out of equities into bonds. The bond allocation was up 12% in the Both Merrill Fund Manager survey, while the allocation to equities, I didn't see it, but I believe it was down. Was it 22%? I believe from equities out from in the fund manager survey.
That's I mean that sounds pretty much right. Yeah, I mean the bond market's been nuts, and we talked about this last week that it's remarkable. The most remarkable fact continues. The most remarkable fact I said last week was that the CFTC data on bond futures showed that people were still net short. Large speculators were still net short the ZB, and that I said I thought that probably would be switched this week, but it's not. They're still net short bond futures even through this massive run higher. So I'm just flabbergasted by that. I don't know what to make of that, but obviously the big money is moving into kind of recession bets, and we saw that echoed in the fund manager survey that we've got the highest level of recession expectations over the coming 12 months that we've had since like 2011.
So who would be the people that are shorting bonds here, in your opinion?
People who are gonna have short careers.
So
I mean, that's how
people
can you
be
say
driving
unless it's
in a couple of weeks?
Unless it's a hedge by the same people who've been pouring money into bonds.
Yeah.
You know, I mean,
protect yourself to the downside.
Yes, but it just seems. I mean, I don't know. Bonds are liquid. You know, it doesn't. When you're talking about 10-year, 30-year stuff, I mean, it doesn't seem like you would need to. I don't know. It's just weird because it's been that short position is relatively unchanged from the lows in bonds, the highs in rates from late last year, September, October, November. Like we got that big breakout in rates higher. That's one of the things that started that decline in October was the sense that risk parity funds were going to be really screwed by the mounting volatility in bonds as bonds crashed to the downside, rates crashed to the upside at the end of September, and that short position went to kind of all-time highs during that move as they were making lows, and we've seen a huge rally in bonds since then, and it's still there, and it's relatively unchanged. I just do not understand it. I cannot. It's the strangest thing, probably of anything, about this market right now, is to see there's such an active participation continue short bonds.
Well, yeah, I mean, I think it's just got to be a matter of all this global bond yields that are in negative territory. People just don't see it as sustainable, right? I mean, that's probably the biggest reason for them moving into it. I mean, it seems like hedgers in general are just kind of getting themselves into a little bit of trouble. Like some of the positioning that I was looking at in gold and the Japanese yen, with the hedgers taking the other side, and the British pound being another hedger's move to one of the largest ever long exposures to the British pound. I guess maybe the idea that a hard Brexit doesn't come into play and sterling just rips higher. But are you seeing any of that activity in any of the data you're looking at for the commitment of traders?
For which?
Well, so basically I was looking at hedgers getting heavily invested in shorting gold. Was one of the things that was sticking out, and the same thing with a heavy short in the Japanese yen as well.
Right. So, I mean, you got to remember the hedgers are the opposite of the speculators, and it's a zero-sum market. So, somebody's got to be selling those speculators their contracts, and I think that with the intensity of the gold upward trend, I think most likely, I mean, it takes each side to make a market, and it's just a market being made. But I think that the growth in the hedger short position is more a function of the growth in the bullishness in gold from speculators. So it's an aggressive wish to purchase speculative long position in the futures in gold, which accounts for the commercial hedgers then being the source of that supply. So, it has to be the case that, and so what you've got is essentially gold miners who own gold long in the ground, are willing to sell futures contracts to speculators who want to purchase that gold that's already in the ground for some point in the future. Essentially, the gold miners are selling gold as the price of gold goes up. And the speculators are willing to bet on a continued squeeze higher in gold. And we've kind of played this from the long side. I, happened to be long gold for this period, and it really worked out nicely, getting almost exactly to my extended outside target today. And I finally closed that position. And we've now got a speculative long position from the specs. We're net long almost 300,000 contracts. And I said, when I first got into the position, that 300,000 area was a typical area that had marked recent highs when we had really seen a lot of interest in gold on the speculative side. So it took us a while to get there. I think we were right at 300,000 back in 2016 when we marked those highs, and that was an important threshold to rematch. So we've gotten there at much higher prices now. And we've also gotten to resistance in gold at the underside of the range that defined kind of the zone around the all-time highs where we hung out for, a number of months back in, 2010, 2011. So we punctured back up into the bottom side of that range, and it's kind of a resistance point. So I think the stars are lined up for some kind of more extended consolidation now in gold. When you look at the open long position for speculative money, the resistance level, the degree of momentum that we've had, and getting to kind of some technical strong targets. But yeah, I think that more than we're seeing commercial hedgers get bearish on gold, I think that it's the gold miners who are long gold by default because they own the gold mines are selling to speculators who are willing to bet on continued momentum.
All right, so let me ask you this. We started off that conversation talking about the bond shorts, which, you talk about, is it all-time high positions short bonds right now?
It's not all-time, but it's still net short. I mean, I would think we would
short.
be net long at this point, and we're nowhere near net long.
Well, it's funny because, you look at the Bank of America Fund Managers Survey for August, and they talk about long U.S. Treasuries being the most crowded trade. This was 32% of the respondents here. So I guess the question is, and this is the difficult thing, because for me, I would be thinking, I know a lot of people I talk to, they're talking about just getting into dividend stocks, and certainly we'll get into that allocation here in a little bit, but they're getting into dividend stocks just because, the S&P average dividend, I haven't seen what it is, but my assumption is that it's well above the 10-year and what it's paying right now. Do you see the only way higher for that kind of break off top in equities as being the only way we can really truly get that is if we see kind of a rollout of this bond trade? But again, how does that work out in terms of where you got the net short exposure in bonds? You have the U.S. Treasuries as the most crowded trade according to 32% of the respondents in the Bank of America survey, and you just continue to see the inflows into debt and the outflows in equity. How do you see that resolving itself in any particular way? Because it seems like trying to figure out that mystery is where you're going to be making the most money.
Yeah, and I mean, there's a couple.
Do you understand what I'm asking? Or
I do, I think, and I think there's a couple of different relationships to think about. One of them is bonds and stocks as far as allocation, but there's another one that's already been momentous right now, which is U.S. versus rest of world. Sure. And there's a lot of money that's just flowing into the United States, especially if it looks like our central bank is shooting for but failing to quite reach convergence. So we end up being divergent in terms of asset prices, even though we're trying real hard to be convergent in terms of policies, but we can't catch up fast enough, and it puts a continued carrot out in front of the idea that you've got a strong growth market, or well, at least, by far and away the cleanest shirt in the laundry
Ju-
in the U.S. with
just
a bank cutting rates.
Right, just to build on that, Brett, in the fund managers survey, U.S. equities are the most preferred region over the next 12 months, despite 78% saying the region is overvalued. That was
Yeah,
something
right.
that
So they
was really
know it's
sticking out.
overvalued. Yeah, they know it's overvalued, and they're pouring money in
And they don't
anyways.
care.
And I think it's that carrot. I think it's the idea that we've got 2% plus GDP, and we've got decent earnings, and the central bank is still cutting rates anyways, and that becomes more the case if there is the narrative underneath the surface, which is more about trying to be convergent with other central banks around the world, and that's not so much about the White House saying we need to weaken the dollar. It's just about the central bank doesn't want to get too far. I mean, this is the reserve currency of the world, and the United States doesn't exist in a vacuum. And if everybody else is really starting to move toward much more accommodative policy, then the Fed is going to have to follow that move, even if growth is satisfactory. And I think that combination really suggests that this is the place where money is going to flow.
Is there anything that the Fed could do in September you think that could pop the bubble for the bonds?
For the
Not saying that it's necessarily a bubble, but to
right.
cause that move.
Yeah, to cause money to flow out of the bond market. I'm not sure, because there's policy, and then there's the world, and it's the relationship between the two that defines the curve. So I guess if they got even weaker, even more accommodative, we could possibly start a steepener trade.
Yeah.
And we could see some of the long-term money come out, but I'm not sure that would work in the current environment, because you're still dealing with. I mean, ultimately, the bond market it's a globally fungible market, and we're seeing a lot of money. We talked about the Japanese post office a couple weeks ago, or 3 weeks ago, or something. They've got like $1.8 trillion under management, and
That's most post offices.
Yeah, exactly. Right. So I mean, it's sort of evolved over the decades to be more than a post office, obviously.
Right.
But they have this massive amount of money under management, and the only way that they can secure some kind of return is if they're getting involved in things with a fixed rate return of at least like 60 basis points. And there's nothing in Japan that pays that. So by necessity, a lot of that money has flowed into the U.S. bond market, and you've got financial firms all around the world kind of in the same fix. And so that's money buying our bonds and forcing our rates lower, no matter what the Fed does or what U.S. data is like, simply because there's fungibility, cross-border flows in bonds. And I mean, the currencies just aren't volatile enough to cause the forward contract pricing to make the hedging has been the factor. Like how, if you're doing that with your money from Japan or from Europe, you have a currency factor risk where the currency can fluctuate in value to enough to wipe out those gains. So you have to hedge that exposure to a degree where you stabilize the currency risk and you still pick up the fixed income price. But the cost of doing that for contracts, and you're essentially dealing with a premium function, that can eat into. So like, let's say you're getting 150 basis points on something, but it costs 120 basis points to hedge it. You're really just getting 30 basis points, so you don't really need to leave Japan if you're dealing with maybe moving up to corporates. So there's that balance, but currency volatility has been a bit lower by and large over the last year, and we've seen forward rates for hedging currencies for people in this position come down a bit, and it's become a little bit more possible to really take advantage of differences in rates. And where U.S. rates go, I think, is pretty much a function of that balancing act. Obviously, foreign money is going to take advantage of that spread and the fungibility when they can, and to the degree they can. And as currency hedging increases in price, it reduces the amount that foreign money is going to support our bond market. So there's always those relationships, but by and large, it's pinned to some extent to foreign rates. And if we just continue to see, I mean, everything in Germany is negative. Japan is moving in that direction, and there's a lot of places around the world, and you're seeing all of these new issues crop up where banks are thinking about their long-term survivability in an environment where, maybe we've got negative rates across the curve for the next 10 years. What do they do? So, the United States is going to be dragged into that without any question.
Just buy Argentina 100-year bonds, right, Brett?
Hey,
That's
there
the
you go.
answer.
I mean, that's obviously a very sound investment.
But so I mean, and just keeping an eye on the markets here as they are slipping a little bit towards that 29.25 level. Obviously, we'll want to keep an eye out on that.
Yeah, this is what I wanted to see, just to remind everybody. Like, I
Right,
wanted to get
exactly.
long, but I didn't want to get long now. I wanted to see the market try to rally and fail, roll over and dump under some levels, shake some people out, and then maybe look tomorrow morning for a move above this morning's highs.
And is the S&P your favored indices right now, or will this all be pattern dependent for you again?
This will always all be pattern dependent, and probably I'd lean by thinking that the NQs have been slightly relatively stronger in this pattern. So when the S&P looks like a setup, I may buy the Qs.
Okay. All right. Do you find the irony that we just talked a lot about the corporate bond yields and treasuries and everything that investors are saying that corporates are excessively leveraged, yet they're still willing to buy that. Do you find that an irony?
Yeah, I mean, I guess it's
It's clean as shirt in the laundry, basically.
so that's
Story-wise,
painfully reminiscent of like 2007 with mortgage-backed securities
Sure.
and collateralized notes and some of the stuff we saw then, where you kind of know that that there's something wrong with this decision, but if you're not playing that game, and we're dealing with leverage here, so they don't make a lot of return on any one unit, but they leverage their capital up into multiple units, bang for the buck. So you're dealing with people levered 14 to 1 or 20 to 1. So the returns they're making are actually sizable, so long as we don't see that market really run into trouble. And you're dealing with a bunch of bond managers who are sitting there saying, if this market continues to creep along like this, and I'm the only one not levered 20 to 1 and making a ton of money, then I'm going to lose my job. And there's a bunch of other folks that are willing to say it's going to be fine for now. I need to be in this trade, and this is something that the music will stop on at some point here. And there's just going to be a very sharp and very fast and very painful unwinding, I think. And but that could still be 12 months away. It's a lot like that. We crept toward this 2005, 2006, 2007 with the mortgage collateralized notes.
It could be even longer, right? Because another thing
Who
from
knows?
the fund manager survey,
The Fed is highly involved in that equation too, and if they keep getting pinned in this situation,
they're
then
going to
yeah,
keep buying, right? So,
that can just keep extending.
and again, a third of people are looking for a global recession in the next 12 months. It's the highest since 2011, which I guess would have been right around the Greek exit, the Grexit talks.
Yeah,
right?
the whole we're going to do whatever it takes thing and everything else.
I'm trying to think of anything that was sticking out at that time frame in the U.S. Can you remember anything that was U.S. specific?
Well, I mean,
obviously, we're a little bit of a feeble
fears
economy
were
there.
Yeah,
That would have been before
was
any
QE,
of the QE,
was that,
right?
No, that was QE, well into QE2.
Was that well in it? QE2
Yeah, 2011 was the beginning of the 2011 was the beginning of Operation Twist.
Yeah. Okay.
So we'd already had QE2, and we were headed toward Operation Twist, and then QE3, 4, ever, whatever you want to call it, the next one. So we were past QE2 into Operation Twist, and constantly fending off the idea that we were heading back into deflation.
So it had to be in Europe, right, in 2011, just washing ashore. So pretty much similar to what we're seeing right now.
Right. So we're starting to see that old sense of, we're moving from a warm period back into an ice age in terms of the animal spirits in the financial markets.
Okay. Does the cash positioning have you scratching your head at all with us, like moving towards the all-time highs, but it's still in pretty bearish territory?
Yeah, no, I mean, it fits with everything else, I would say. I mean, people are cautiously positioned when you're talking about professional money managers. And that's another data point, I think, generally speaking, the one thing that we've tracked over the course of this is that large professional money managers are very skeptical about being involved in the equities market, and they've been that way the entire year. And the big question is, could they be forced into the game by a sense of, benchmarks running away, and would that trigger kind of blow off if suddenly we started to feel like, there's real light at the end of the tunnel for some of the things that seem like risks, for instance, the trade war and the problems with business investment and spending? Would that draw all that sideline money rushing back into the market as people start to realize this could be the type of year where the market's up 70% And for anybody who's been sitting on the sidelines the whole time, it's just that's it for you. And we didn't get it. We started to roll back over, and I think that's one of the reasons why we haven't seen a tremendous amount of skewed put call readings, is because probably the people who most take advantage of that device as a hedging device have had light exposure. They've been in the bond market, they've had higher than typical cash holdings, and they continue to be sitting in that situation. And I think we've seen other sources of money, or kind of a more balanced set of forces in the market that are kind of sloshing in one direction to the other, but it doesn't seem like that cash is ever really. We're not getting a monthly report from FMS showing that at least the clients for Bank of America's prime brokerage are seeing big jump in allocation of that cash. It just sits at this 5 to 5.5% area.
All right. Any thoughts on the CPI this morning? Just one data point. No, I'm not too concerned about it.
I mean, there
definitely doesn't seem to be any concern. Another item that was sticking out was investors expecting higher global CPI over the next 12 months was at 8%.
Yeah, but the wage growth numbers were really, really weak. So I don't know what was in there, but I think that it takes wage growth to continue move toward higher inflation, and that massively underperformed in that report. So I think it was weird data this morning, but I don't think that it was the type of thing that would shift anything in the Fed's mind.
Okay. What would be some of the things that you're going to be keeping your eye on when we come back next Monday or Tuesday? What are the things you're going to be focusing on within the next week? Or are you kind of letting things come to you?
Yeah, I'm not trying to make too many assumptions right now. I think that the trading opportunities will be many and interesting as long as you just kind of stay in the mindset that we talked about at the end of the show last week of just, realize that there's a lot of opportunities. If you're selective, you just know the sorts of things you're looking for. You are really good about saying, hey, if this isn't working, just get rid of it. And don't get married to any ideas. Just kind of stay in the flow of what the market wants to give you, and don't make too many assumptions. But looking out over the course of a week or two, the scenario that we talked about at the beginning will form basically a fence that I'm sitting on. Are we starting to see the market underperform relative to changes in sentiment? So do we see a lot of easing of some of the day-to-day data that we get, the SPY liquidity premium, the VIX term structure, what we do see as far as put-call stuff, where it starts to taper back toward optimism, but the market underperforms in terms of its upside movement. In the context of that, it starts to build a case for the possibility that we have that bearish setup that we talked about at the beginning, where you see the market really not getting anywhere close to making new highs, but sentiment starts to move back up close to the types of things that we saw at the highs back in July. That forms an extremely bearish setup with implications for a swing position to really knock this market more significantly lower and maybe move, well below the lows that we saw back in May and June, and back, who knows, maybe to test what we saw earlier or at the end of last year. That's a possibility if we start to see that type of data. If we don't, if we see the market move higher, sentiment stay very bearish, people still seem very cautious, but a political resolution could solve everything, and there's a ton of dry powder on the sidelines, then you've got a lot of squeeze potential. So that's the fence that I'm on, and just watching how this progresses, how the pattern feels, and how that data evolves will be really basically what I'm dealing with. And the other thing is, last time we talked, I said I thought that I covered my crude position on the short side too early, 53s somewhere. But my ultimate target when I put it on was about 50.6. We got down right about to that level, and then I said I thought that we were building a descending triangle, which would entail a sharp bounce from there. We've seen a sharp bounce, got back above 57 today, so shorting crude, particularly following tomorrow morning's data, is also going to be a priority of mine.
Okay. Quick question and feedback, Brett. If the 2s and 10s do invert, is it conceivable we could see an algorithmic reaction sharply down, or is it now fully discounted? I'm not sure if the mean invert back to positive territory or move
We're
deeper
still
to negative
positive right now,
territory?
right? By like three, isn't it like 3 basis points
Yeah.
positive? So it
I,
hasn't inverted yet.
I mean, I'm sure there's some algorithms tied to it, right? But I don't think that, I
I
think
don't think
it's
it's
got to be a
inverted.
sustained move in order to really rattle the markets at this point. And for me, I don't know how you think about it, Brett, but I feel that a lot of people who read that just no longer take that into account because all the central bank activity over the last 10 years has really kind of distorted that curve.
Yes, so that's another huge factor. So there's two things: the fungibility, cross-border fungibility that we talked about, and that it's not necessarily representative of the U.S. economy in a vacuum, but it may be representative of the global economy, and that maybe that's a bigger factor. But yes, there's been an enormous, enormous skewing of the meaning of any of these measures based on what central banks around the world have done, and that's in terms of just total supply and liquidity, and also in terms of pricing. So it's I think that there is a reasonable and justifiable skepticism about the straightforward application of meaning of yield curve inversion right now, but it may be something we look back on and go, gosh, we were stupid for thinking that it's this different this time because the thing happened and then the thing happened. And it's possible that will be how it plays out, but I think it's reasonable to think that a lot of these factors, when you're looking at different yield curve relationships, 2s, 10s, 3-month 10s, 530s, 2 7s, all these things they've all got kind of similar signals except for the 530s. But they're all these same signals that suggest that, where policy rates are is not in line with where inflation expectations are, broadly speaking. And that's typically been something that precedes a recession within like 12 to 18 months over the course of history. It's been really reliable, and it's showing all that now, and 2s, 10s would be another kind of nail in the coffin from that point of view. But yeah, central banks have massively skewed the meaning of all of the prices because it's not market driven in any way when you look at the big picture of global 10-year interest rates. It's not representing a free market driven number this time around, and it has in the past. So I think there's a very justifiable amount of skepticism about the meaning of that indicator.
Okay. All right, Brett. Well, anything that you want to add at this point then, or um, anything that we might have missed?
No, I don't think so. I mean, just to summarize, we have seen a sharp drop. That drop, I think, has been driven by a few different things. We talked about them earlier. But, the lack of an underlying bid supporting this market when push comes to shove is a big part of it. And policymakers enabling a seemingly infinite escalation of the trade war is a big part of it. And China realizing they can use the yuan, which exports deflation, into a global picture that is already really worried about deflation risk. That's a big part of it. Whatever it is, though, people have gotten really skeptical, really pessimistic, really bearish, really fast. And a lot of times that's just another buying opportunity in a bull market. And we're going to find out when we see more of the evolution of the relationship between reaction moves in the market and sentiment data as it starts to lay itself out over the next week to 2 weeks. It's going to give us more of a signal of whether or not we should be looking for this big squeeze back to the highs or if we're putting in place a more important topping process. So we're going to follow that closely. But right now the action is spectacular to trade just intraday if you're selective and you really kind of are disciplined with your risk.
All right, perfect. All right, well, Brett, as per usual, thanks for joining us here, and we will talk to you shortly.
You got it. Thanks, Gav.
All right, take care.
You too.
Bye bye.